Remember, when looking at a project in the, as an investor, your interest is on the returns. Returns go with cash flow. What type of cash flow or what cash flow are you expecting back? So this method that you want to use to evaluate these projects should be able to use cash flows instead of accounting profits. Now, even as I look at the characteristics, we are looking at the characteristics of the best fit technique, but again, we are looking at the techniques themselves. I've already mentioned to you the non-discounting techniques. 1, payback period. 2, accounting rate of return. I believe I've also mentioned what is payback period. It is the period it takes a project to recover your investment, right? Accounting rate of return is an evaluation technique that looks at the profitability of a project and compares and gives you an evaluation comparing 2 or more projects. And this one picks its figures from income statement. Now, discounting techniques, one of the discounting techniques that I would want us to look at is now discounted payback period. Now, when you talk about discounted payback period, what do we mean? We are still talking about payback period, but now the cash flows that we are using to gauge the point at which we are going to recover our investment, we are using discounted cash flows. We don't use the cash flows plainly the way they are given. We are now discounting them further. Whenever you discount, you are going to take care of the effect of time. Time value of money is being taken care of at that point. Now, as a finance student, I want to remind you and I want to take you back to make sure that you remember how you computed present value and how you computed future value. Now, when we talk about present value, you already have a future figure and now you are required to discount it back so that you get the current value, right? Now, that is computation of present value. You use discounting. And when we look at the factors, discounting factors, you talk about discounting factors, it is 1 plus r raised to negative n. I believe as a finance student, you remember that technique very well. And in fact, we already discussed it in the previous class, and I'm seeing we already wrote it even here. So you can look at my screen and you see discounting is 1 plus r raised to negative n. That is the discounting factor. Then whenever you want to compound, your interest is to get a future value. You are compounding from a current figure so that you get to see the future one. Now, you use that future value interest factor, which is 1 plus r raised to n. Remember, when discounting, the n is negative. N represents the period or the number of years. And then when you are compounding, that n, which you raise on top of the bracket after 1 plus r, close bracket, then you raise n, that n, when you are compounding, you do not include a negative, it is positive. When discounting, then now that n raised to negative, make sure that n is negative. Very good. Now, discounted payback period is very interesting.